still think I come back to the thing that Nelson always said at the very beginning, think long term. Because you're really starting your own business just like any other business and any other bit. And we don't even have to talk about the banking business. You could talk about any business, whether it's a grocery store that he talks about in his book, whether it's a plumbing business, whether it's an electricity contracting business, whatever business is, you're going to have a capitalization period.
Bruce, thanks for coming on today. And we just want to kind of get to know your background and how did you discover becoming your own banker and the infinite banking concept?
The short answer is after the 2008 mortgage crisis, one of my partners, Mark Benson, and I attended a night of clarity in Nashville in 2009. And we actually sat in the front row and we talked to Carlos and Bob Murphy. We're associated now in different ways with the Nelson Nash Institute. But really, I used to joke around with Nelson that I was doing infinite banking before it was cool, because my father had taken a Western and Southern whole life insurance policy out on me when I was born in 1963. And then in 1986, my father actually turned the policy over to me, and I had no idea I even had it, and I became the owner of it. And my wife and I in 1987 then borrowed against the cash value to put our first down payment on our house. And so that's why I was joking with Nelson all the time, is that I was doing this in the 80s and I didn't even know what I was doing, but it was before it was really cool like it is now. So I was familiar, and so was Mark Benson, with the design capabilities of whole life insurance, because almost at the exact same time I bought my first house, Mark and I got involved with a organization in the St. Louis area that was approached by Franklin Life to actually show the benefits of whole life as teachers. We were both teachers at the time, coaches, and their marketing was to go out to the educational community, find good coaches and teachers because they thought they would be really good at teaching this concept. And David, it was kind of interesting because although it was whole life, it wasn't about infinite banking. It was about becoming the lucky 3%. And the lucky 3% in their world was there only 3% of the people retire comfortably. And so they said if you were to fund whole life insurance policies, and we had a whole presentation on this, that you could then retire with a passive cash flow tax-free into retirement. And so we did that for several years. And then I was still very young. I was in my mid to early or late 20s. And I tell this story all the time. We were going hard, Mark and I. We teach all day, we coach after school, and then we'd go on appointments 2 to 3 days a week in the evenings. And then we just keep repeating it. And then after doing this for about 3 years, at the halftime of a basketball game where I was assistant coach, I actually thought I was having a heart attack at like age 28.
Oh no.
And it was because I was so tired. I was always drinking caffeine, always. But luckily I had several whole life insurance policies, so I had the death benefit covered at that time. So if I did die, my wife was going to be taken care of. So that actually started my journey actually away from it. And Mark continued. He actually got out of education and started his own agency. And then I stayed in education, and it's a long time period. I actually started other businesses at that time. And then in 2001, I was recruited to actually start a Catholic school in Rancho Santa Fe, California. And Lee, I know you've been in private schools before, so you're probably familiar with they don't always know their direction in what they're doing. And fundraising was number one, and they had hired me for fundraising. And let's just say that was a disaster. And I knew within 15 minutes of actually taking the job that it wasn't a good situation. And I was confirmed about 6 months later that it was I did not want to be in the organization anymore. So I stepped away, and my wife had a really good job. And so I started looking for other businesses to buy because I didn't want to get into education anymore. And I bought an automobile repair business because my father had one growing up. So I worked with him. And then my wife's mother died. So we moved back to St. Louis to be closer to her dad. And then I got back into Mark's organization in 2007. And then Mark and I then attended the Night of Clarity in 2009. And then from then on, we just pivoted our whole life from being only what we call pension maximization with teachers to also concentrating on the infinite banking concept. So that was probably more of an introduction than you wanted to know, but
Yep.
uh, that's basically my story. And just to kind of put a bow on this, Franklin Life actually demutualized in the early 90s, but I still have those contracts that I have, and they still perform pretty dang well. So when people talk about how, demutualized companies are not really good to use, they might not be good to use, going forward, but you should not be getting out of those contracts, in my opinion,
Well,
because they still perform very, very well.
I tend to agree. I had the same problem. Nelson was contracted initially with Equitable Life in the United States in an agency format, and so all of my early policies were all Equitable policies, and when they demutualized in 1992, I think we exchanged most of them, but I did keep two of them, and they continue to perform. The problem is, from my perspective, as long as the company doesn't dissolve and somebody else buys that book of business, if the company's still performing, even as a stockholder company, then you still have solid participating whole life policies, right? Yeah.
Yeah. You just need to do the math and look at it, whether you 1035 them or not. But usually a really mature policy, it's really hard to beat it. So I always tell the people that I mentor is don't make blanket statements. Don't say, well, this is the absolute way it has to be, or, oh no, you have to get rid of that when you haven't even analyzed the situation. And so, but I think most of those mature policies are going to be really good. And of course, then if you want it for more, PUA development or more dividend driven, then you can do if you're still healthy, you can do another contract along the way. So
Dr. Murphy and Carlos Lara, Nelson and I, we set up the Institute, Dan and I, and Bob and Carlos were part of that also. And back in the early days, back around 2009, Carlos came up with the idea that we'd have a think tank in Birmingham once a year for our producers. And then we'd have, then they'd host this Night of Clarity in Nashville, because that's where Carlos lives. And it would be more attuned towards economics, specifically Austrian economics. So they invite some heavy hitters in the Austrian economic community. And Ron Paul was a guest one year on that.
Right.
And so, that's where I met you at that first one, you and Mark. And those events were really good. I think they did them for 3 years, and then they decided to stop doing them at that point.
It was very eye-opening. I remember that was the first time that I was exposed to fractional reserve banking. But the real eye-opening thing was that Carlos was talking about how he was actually going into different banks, regional banks, and so on and so forth, and talking to the vice president and presidents, and many of them didn't really understand fractional reserve banking also, which I thought was very, very interesting.
Yeah. Nelson say that they weren't bankers; they were the flunkies running the banks.
Right.
The bankers were the guys that actually were making the income, and they're the ones that were totally invested in the fractional reserve system. So,
yes, and so then what actually happened then after the Night of Clarity, Mark and I continued working with teachers, but now we actually looked at not just using it for pension maximization, and I'll explain that real quickly. So, public school teachers are or any government are the only ones that really, really have pensions that survive, because most of the corporations have gotten rid of them. And so the government organizations will allow you to retire under a benchmark, whatever that benchmark may be. And then they'll say, I'm just going to use this as an example. They're going to say, you can take $5,000 a month, for the rest of your life and leave your spouse with nothing, or you can reduce it because now you're going to cover 2 lives. You can reduce it. Usually it was right around 10%. You could take $4,500 a month for the rest of your life. And if you died, then your spouse would continue to get the $4,500. Well, that $500 give up was given up then for the rest of their lives. And if the spouse messed up the situation by dying first, then they've given up all that money and there's no benefit. And it just so happens in the school system, I'm sure this is like this in most states. In Missouri, 79% of the teachers were actually female, and females live longer than males do. And so, but they're also very compassionate and empathetic, and they want to take care of the family. So what they were always doing was taking this reduction. And oh, by the way, in Missouri, if you work 30 years, you can actually retire with the same income retired as you are working. So if somebody comes out of college at 22 or 23, by age 52 or 53, they're retired. And so they're going to have a normal life mortality of 25 or 30 years of giving up $500 a month, plus cost of living adjustments. Well, the cost of living adjustment on a $5,000 a month is bigger than the cost of living on $4,500. So they were literally giving up between $200,000 and $280,000 at the hopes that they would die soon. Because if they would die soon, then they would get the advantage. The spouse would. Most of the times it's a husband. But if they didn't, then even if they died at 85, the spouse is now 85 or 86 or 87 or 89. They're not going to live long enough to recoup between $280,000. So our solution with them was what we call pension maximization. Is why don't you take that give up along with some other assets, take the $5,000 and take the give up to $4,500 and place it into a whole life insurance policy. And that whole life insurance policy then would take the place of the pension payout for you. And oh, by the way, if there's any left after the spouse dies, then it goes to the next generation. But you can't do that with a pension. It only goes to the recipient and then the spouse. So that's how we built our business. Now, when we come with the Nelson Nash Institute, we were like, oh, we have something else now. Along the way, you could actually use it for banking. So you could pull the money as a loan against the cash value. You could then go do the banking, pay yourself back. And now you don't have the same finance charges over here, and you are actually saving on your pension survivorship. So that's how we built the business with the Nelson Nash Institute.
The 5,000, 4,500. Okay. Were they buying premium, $500 worth of premium or $4,500 worth of premium?
Very good. It's $500 worth of premium.
Okay.
However, David, I'm sure there's going to be some people, experienced agents, listen to the podcast. So they're going to say, well, wait a minute. That's no way that's going to buy enough death benefit to actually take care of the pension. And number one, we explained that. Number two, if they had other assets, we would actually supplement that. So instead of going $500 a month, we might do $1,000 or $1,500 or $2,000. And then that's where we really would accelerate the banking portion of it.
Yeah. So you said you're finding additional cash flow.
Correct.
In recovering that and directing that towards premium also.
Correct.
Yeah,
Correct.
Kind of the same. I tell the same story for me as a retired military officer, Army officer. The Department of the Army, along with the rest of the federal defense people, they have a survival benefit program. Same thing. when you retire under my system, I don't know what they're doing now, but you get a certain percentage based upon the number of years, active years. And then if you elect to provide for your spouse, if you do pass in retirement, then you can enroll in the survivor benefit, and they deduct a certain percentage from your retirement check. And then when you pass, your spouse gets, I don't know, 55% of wherever your retirement pay was until they either turn 80 or they pass themselves. Well, I did the same thing. I figured out what the difference was, and I just bought a whole life policy with that difference. So, if I was getting $5,000, instead of deducting 500, I just took that 500 times 12, bought a policy, put it in force, and I still got it, still use it. So that's what's going to take care of my wife, along with, I don't know, 10 or 15 other policies, but whatever.
Yeah. And I would caution, who's ever listening right now, if you're a person that's not an insurance agent, I would caution you to make sure you get some good advice before you would try to do this yourself. And I would caution the insurance agents to actually understand what you are doing, because if a person is not committed to seeing this through, then not only are they not going to have the death benefit from the whole life, they're also not going to have the survivorship option from the pension. And so you have to really be very, very clear and understand that these people have good money habits, just like Nelson talked about in the book, with the human condition. People that were doing this for pension maximization are also, they fall to the human condition, where they weren't, funding their whole life to protect their spouse. And so you had to be very, very clear to them that this is not an option, and it's basically the same thing we do with the infinite banking concept, is that you actually need to pay back your loans, because you're always going to need the capital. And if you do not, you're going to get that compounding effect on the loans that may not outrace the compounding effect of the interest and dividends. And so it was a very similar thing that we had been doing with our clients in the educational process. So it was very easy then to kind of shift over to helping people with the problem of the 34.5% of interest volume going out.
Yeah, I mean, I'm glad you brought that up, because there's so much dialogue going back and forth on social media, especially about you don't have to pay these loans back. You don't have to pay them back, because death benefit will cover whatever loan you have. Well, that's a true statement. However, with a dot, you've got to understand and work with somebody, an insurance agent who has your interest at heart, and they're not just trying to chase a huge cash surrender value in early years. These policies, it's got to be something that you can manage, and that number one, how to manage these policies. Otherwise, it's trouble, big trouble. So I guess the word I'm looking for is, if you don't have a coach, like an assistant basketball coach, or a financial advisor who you trust and knows what the heck they're doing, or even better, an authorized IBC practitioner coach, then you need to find one so you can really maximize how IBC works in your life. So anyway.
Yeah, what's interesting, and Nelson knew this in the book about the human condition, and I think our practitioner buddy James Nethery says it all the time. It's never a problem until it's a problem, and people don't think it's ever going to be a problem. But when you work with somebody that's done literally thousands of these contracts, you understand the problems. And the biggest problem I see without paying the loans back is it's a short-term thinking, where Nelson talked about long-term thinking, where you actually capitalize these like a bank has to capitalize. I actually have a really good friend that had a mortgage broker business. And because of the way the regulations were, he had to do so many impoverished mortgages, or he could not maximize his regular mortgage business. There was a regulation. And he also, if he wanted to do in other states, he had to have an actual bank And so he started a bank. Well, it took him like 10 years to obtain a bank charter. He had to get the capital. He had to put it into escrow, something like $20 million for 10 years. And so he had to capitalize before he could start the bank. So I have seen through my buddy how much it takes to capitalize an actual bank. And yet we're hearing people that are capitalizing 1 year. And I was just at one of the local offices, insurance offices, and they said they are seeing, in-force payments and loan applications coming in at the same day. So people are paying their premium, and then they're also doing a loan request the same day. Now, they can't, it takes a while, at least 20 days for most policies to actually get credited for their premium. But then that is a very dangerous thing, because if people understand how interest and dividends are applied to a policy, most of the dividend is based upon the permanent death benefit, or how we often talk about as the base death benefit. And when I say most, we're talking 90% under most insurance contracts. So 90% of the dividend is on the base death benefit. So what ends up happening, if you pull that base death benefit down, your dividends are going to be very, very small. So then the PUA is only 10% of the dividends. So now what happens is you borrow right away that 90%. Now you're going to get interest on that 90%, but you cannot actually support the interest with that small base death benefit. And so that's going to compound much faster over here than it compounds on the base death benefit. It'll be okay for a while as you pay your premiums, if you pay your premiums, okay? You pay your premiums, but eventually that is going to outrace it. And we have actually modeled this with people over and over and over. And as Nelson said, if you see what the problem is, you're going to know what to do. Well, if you show people what the problem is by doing these skinny based policies, then the people don't accept them. The problem is they're not working with an experienced or an authorized practitioner that understands this. And they just think, oh, well, the death benefit, it's going to come off the death benefit. Like you said, David, that's true. But if it compounds faster than what the premiums can compound, you're not going to have a death benefit because it's not going to stay in force.
No, you'll have other problems too. You have modified and dynamic contract problems going down the road. But yeah, I mean, you're right. And I looked. I don't want to mention insurance companies on the channel today, but
yeah.
Some of the companies I use, when you get your annual statements and you look at the dividends and whatnot, they don't break it down about the different components in the dividend. You just get a number. Here's your dividend, wham. Where I've seen other companies where they actually break down the components, so you can see what part of the policy, what premium is actually contributing to that dividend. And it was shocking to me when I saw that, because I was never exposed to that before using the two companies that I currently use.
It's an eye opener, isn't it? Yeah, it's a real eye opener.
So I wish every company would do that, and I think it would help solve that information flow. But you're exactly right. The longer you capitalize, and the key word is capital. Okay, the more stable the policy is going to be. That's probably the wrong word, but it'll. When you start taking out loans and whatnot for whatever, then you'll have a much larger margin, and it will be quote unquote a skinny policy. And you have more options for loan repayment, right? And you can, if you want to explain that, you can go explain that. And it's not just principal and interest. There's other options in loan repayment, especially if you're borrowing at 6% and paying back at quote unquote a 10% rate, even though that's you. So anyway, there's a lot of benefit to understanding how to do this and doing it right, and growing a policy as you're repaying back loans. And most people don't understand what that means or how to do that.
I come back to the thing that Nelson always said at the very beginning: think long term. because you are really starting your own business just like any other business and any other bit. And we don't even have to talk about the banking business. You could talk about any business, whether it's a grocery store that he talks about it in his book, whether it's a plumbing business, whether it's an electricity contracting business, whatever business is, you're going to have a capitalization period. And and working capital that you have but not necessarily deploy is really important in those business developments. So I look at PUAs in the early years as being working capital that is a comfort level that you could deploy if you needed it. But really you should be capitalizing 3 to 4 years before you're accessing it. Now, the comforting thing is that if you need a little bit for something in the early years, you could do it. But I think what you were getting at as far as the loan repayments, this is another thing that people don't realize. And a lot of people that advocate the skinny base, they say, well, that way, if you have a skinny base, then you don't have to worry about having this bigger premium. So, so you have a $10,000 a year premium. You only have a 10% base. So then all you're committed to is $1,000. Well, the fact of the matter is that's true, but that also tells me is what you're not doing is knowing your client very well, the potential client, because you haven't taken a full financial picture. You haven't decided what their cash flows are like, and you haven't explained to them the benefits of actually paying the entire premium. And where you're getting at, David, is the dividend and the PUAs are buying more paid up additional life insurance. And that life insurance in the future can be, as Nelson talked about in his equipment financing, it can be surrendered to actually pay the premium if necessary. And when you have a bigger base, it's going to produce bigger dividends. Those dividends are going to purchase more PUAs, and those PUAs then can be surrendered in the future to keep the policy going, so that you could have passive income taken out of the policy in the future, or because life gets in the way and all of a sudden you have something happen and you have an interruption that year. But when you have a very small, skinny base, it doesn't buy very much paid up additions. And so you're not going to benefit from that.
One of the misnomers is, gee, I put in $1,000 premium and look, my policy grew $1,200. So, wow, that $1,000 was fantastic. Well, it grew to $1,200 not only based upon the premium, but also about the uninterrupted compounding of the base. Okay, because the base is the engine that runs these things, and so it's two components: the premium adding to the base, and then the base uninterrupted compounding for the entire base from year to year to year. That's the growth of it. And other aspect I mentioned was, if you borrow the money and you pay it back, the insurance company doesn't care how you pay it back or when you pay it back. And yes, they charge you interest, and in most cases they pre-charge that interest on the loan. And as you pay the loan back, what do? They rebate that interest back to your account. But I say this over and over again, and I'll probably say it every week, that one of my strategies is I always pay premium first, period. Boom, premium, whether it be PUA or base. But the second thing I always pay is interest. And when I say interest, at the anniversary or the renewal date of the policy. So I don't want that interest to roll over. There's no way I want that to happen.
That's one of the big misnomers on TikTok and Instagram land is they say, well, these are simple interest loans, so they act differently. Well, they do act differently until the interest is added and rolled over to the next year, and then they become a normal compounding loan. So what you're saying is, at the minimum, you should be paying the interest that accrued that year, so that it's not added to the loan, so then compound the next year. And that's at the bare minimum. So I think what's really difficult for a lot of people to understand is that the base policy is leveraging a death benefit. And I'm making a blanket statement here because we're not talking about specific ages, but it's leveraging up maybe 8 to 10 times. What I mean by that is a $10,000 base premium might get you $100,000 or more of death benefit, where the PUA then of let's say it's $1,000 PUA, it's only going to get you maybe $3,500 or $3,000 of death benefits. So then that means if you're going to do a 1090 on $1,000 base, and that gets you 10 times the amount or more, you have a $10,000 death benefit, and the $9,000 part of it. I'm sorry, did I say 10,000? I meant like $100,000 of it, where the 9,000 would get you maybe 2 times or 3 times, depending on your age, which is only going to get you $18,000 to $27,000 in death benefit. So you're really leveraging up a higher death benefit and future liability for the company. And so when you then could actually surrender that PUA, they will give you the benefit of that $9,000. So you surrender $18,000, they credit you $9,000 that you can actually use for premium repayment or loan repayment. We don't advocate that surrendering, because once you surrender, you interrupt the compounding of that for the rest of your life. So that's why agents, good agents, experienced agents, not so good agents, whatever you want to call them, they really should be taking a full financial picture. They should be doing yearly reviews, and they should be explaining to you every aspect of and consequences of the policy design, instead of just being what I call order takers. And we see that all the time in our business. You know, we'll have people reach out to us and they'll say, yeah, I'd like to see what you guys have to offer. And then we'll say, okay, well, we want to take a full financial picture. Why do you need this? You know, I said, well, first of all, the insurance company actually requires this because this is an insurance product, and you have to qualify for it based upon your assets or your income. And so we need this for the insurance company. Secondly, in order to design something that we feel comfortable that you're going to keep in place, we need to know this. And then oftentimes they will say, well, the last person just said, how much do you want to put in it? And I told them, and they sent me an illustration. So I want to compare my illustration to your illustration. And these are the things that I say, these order takers are just throwing a bunch of stuff out there against the wall, see what it sticks. And the people don't understand what they're buying, but it's really easy to buy it from them. But then they don't see the consequences down the road. And this is what we're trying to avoid with our authorized practitioners program.
Yeah. I mean, just because, there's a lot of policy design shopping going out there, like illustration shopping, and then they get the one that gives them the biggest bang for the buck, i.e. the biggest cash surrender value, within policy delivery for the smallest premium. And they say, okay, let's go forward with that. And then you could have the potential where you can't qualify for it. Okay. Because you could be rated, or you could, again, your financials weren't taken in the first place. So they won't issue that much insurance, or whatever the situation might be. You're right. It's not about creative policy design, quote unquote. It's about, being a responsible banker with a small b and understanding how this thing works. And, if you understand the problem, you understand the solution. So what's the problem? What are you solving for? That's the inherent part of becoming your own banker. And becoming your own banker is not about how to be a bank. It's not about it's about human behavior. It's about overcoming some of the problems with human behavior so you can be responsible and you can grow your wealth. And so I know a lot of practitioners that will spend a lot of time with a potential client who is drowning in credit card debt plus all the other debt assets, and they won't sell them an insurance policy to use as a banking policy until they can demonstrate the ability to start whittling down and managing their existing debt structure. Otherwise, you're just compounding the problem, because now if your client doesn't get it, then a year later they could double their debt portfolio by having the debt outside their policy and the same debt within the policy construct.
And they have a premium to pay.
And then you have to, now you have to have a premium. So they go, gee, do I pay my credit card? Do I pay my policy loan? Or do I try to scrape up some money to pay a premium? It's just, it's a never ending cycle that they can't get out of because they didn't understand it going into it in the first place. So.
Yeah. I think because we saw the human condition when we were doing the pension maximization, we didn't actually follow that to get people out of debt, because we knew the human condition was real even before we read Becoming Your Own Banker. But over my career, and I don't think I'm exaggerating, David, I probably have tried to help 30 people. And we used to have a credit counselor service that we would refer them to and so on and so forth. I probably had 30 people that, I said to them, hey, these are the steps you need to follow. First of all, you need to know where your cash flow is going, because most people in problem, they have no idea what they're spending money on. So we actually would take them through an exercise with a spreadsheet that they were supposed to fill out every month about where cash was flowing. And then once you get this, and we would show them, okay, kind of like the snowball effect, where, you would pay off one, take the proceeds from that, pay off the next one, so on and so forth. And we would put a timeline together. Out of those 30 people on the last 20, 25 years, you know how many people actually completed that? One person actually completed it. And I think if that doesn't talk about the human condition, then nothing does. So when people are using this to get out of debt, I think it's a very, very dangerous thing.
It is. It's dangerous. And obviously Becoming Your Own Banker talks about, the average American, has 34.5% of their after-tax income and going towards debt reduction in the form of interest. So that is a central component of Becoming Your Own Banker. But being a banker, okay, acting like a banker is much more than debt reduction. Okay, so deploying collateral, deploying assets to grow your wealth also. And so if you just focus on the debt reduction piece, you're missing out probably 90% of the benefit of thinking like a banker.
Another thing, when I was just talking, we were talking about the illustration shopping. Another thing that drives me crazy is, our health is a bell curve. So you have unhealthy people on one side of the bell curve, and you have really healthy people on the other side of the bell curve. And in the middle is where most of the population lays. And that's the way the insurance companies, the actuaries, are designing these things. So that means most people get a standard rating. Most people get a standard rating. And yet when you do this illustration shopping, you would not believe, David, how many times a person's presented a super preferred rating with this. And then, I tell them, well, we don't even know how healthy you are. And people say, oh, I'm really healthy. Don't worry about that. And I say, well, that means you're on this side of the bell curve, a very small percentage. Are you sure you're on that very small percentage? And then I joke around with them and I say, well, you pass the eyeball test, but my eyeballs can't see inside of you. So, and when you do this, when you've been doing this for a long enough time, I've actually had underwriters call me and say, hey, you need to call this client right now and tell them to get to the doctor right away. And they had no idea, but their blood work actually came up that they had a serious condition. So the only reason these people are putting super preferred is so that they could suck these people in and get them to actually get into the application process. And then once you're in the application process, then they think, oh, you only got a standard rating. Now here it is. Well, in that situation, that standard rating compared to your illustration of standard, probably would have been a competitive situation. Or another great one on this illustration shopping is they look all the way out to year 30 and they'll say, look, yours is $10,000 less total cash value than mine is. And I'm like, well, the one thing we know on these illustrations is they're just a snapshot in time. I mean, the one thing I can tell you is whatever's on that page is not going to happen. It could be better or it could be worse, but whatever's on that page is not going to happen. And every insurance company, a mutual insurance company, I tell people, they're good, or they wouldn't be in business for over 125 years. However, each one of the insurance companies goes through ebbs and flows too on how they actually do business. So their ratings, their dividend ratings go down, their dividend ratings go up, they go down. They don't stay in concert with each other. And they're always bragging. Insurance companies are marketing geniuses just like any other company. So they're always bragging about their dividends. And then when their dividends go down, they say, oh, dividends don't matter. And then when dividends go up, then all of a sudden dividends matter.
Yeah.
So, dividends don't really matter. It's actually your habits are what matter. Your habits of actually contributing to a contract is much more important than the design of the contract. I mean, David, we talked about this. I did an all base policy on my wife recently. And that is like the devil with most people. They say, oh, you can't do that. And I'm like, well, no, I wanted more permanent death benefit on it. Well, she actually wanted more permanent death benefit because she was worried that we were out of whack because I had a lot more death benefit than she did. Secondly, we did it 3 years ago when the interest rate environments were really, really low. So the dividend rates were really, really low. So I said to myself, I don't know what's going to happen in the future, but these dividend rates are going to go up again. They're going to go up again. And so I'm going to try to maximize this by having the thing that produces the most dividends, and that's the base. And guess what? The supposed break even part, everybody talks about break even. Well, if a typical 40-60 policy breaks even about year 9, an all base policy breaks even in about year 13. However, the dividends that are being produced are about 3 times as much in that all base. So going into the future, if you're looking at another reason to do more base, interest rates are normalizing. So you ought to get better. If you're really worried about the performance, you ought to really consider that more base, you're going to get better performance in the future. So it's amazing how people fixate on immediate cash value because that's what we're taught, right? You have to have this money available. And I tell people, so you're going to put all your cash that you have in here and you're not going to have any, what I call 15-minute money. And that 15-minute money is money you can drive to the bank and get out of the bank right now. Because people say, I have to have liquidity. I have to. I don't plan on using it, but I have to have it. And I'm like, you're right. You have to have it. That's what the 15-minute money's for. But a lot of agents are trying to get all that money in there and have as much liquidity, right, at the expense of the compounding on both sides, the compounding of the dividends and the compounding of the loans that are actually, the interest rate. What people don't also understand is these insurance companies tranche out business. So they block out this business. And they say, okay, you put this business in place in a low interest rate environment. We're not sure if that interest rate environment is going to continue to go up So we're going to be slow to raise our dividends, but we're also going to be really slow to lower our borrowing rates because they have to be competitive. So borrowing rates right now are actually fairly expensive compared to the dividend rates because they don't know if these these interest rate environments going to stay where they are, or we're going to go through a recession and they're going to drive them back down. So now we have a situation where the borrowing rates are a lot higher than they used to be. And people are like, well, I don't like that. And I'm like, why do you care if you're paying it back? You wouldn't care because so your mindset is the interest is going to be too much for me. Well, that's because you're thinking I'm not going to pay it back. Why would you do that? If you had your own bank, you'd have to pay it back. So why aren't you paying it back to the banking situation that you developed? People just don't think through these very well.
No, they don't. Yeah. Yeah. I came up with a banker's creed a while back. And Nelson said, yeah, it looks good. Go with it. And one of the precepts of the banker's creed was just because you can't take a policy loan out doesn't mean you should. Number one. Number two is, unless it's an emergency, don't think that just because you have the ability to take out a policy loan that you have to have the plan to pay it back in a responsible manner. Okay, so this is not free money, as we all know. But you talked about before about the dividend. But the real piece of the dividend is buying paid up additional insurance. That's the piece. So that just like you have a PUA premium, the dividend, if it's buying paid up additional insurance, can be classified as also a premium component, right? So
Absolutely.
Yeah. So that's the part that I just wanted to bring out for you. But anyway, so you started your journey as a teacher, as a coach. And you got into the life insurance business to supplement your income, because I guess most teachers are getting paid pretty miserable salaries. And then Mark saw that he was making a lot more working nights selling life insurance. So that's when he got out of the teaching coaching business and went full time. But it took you a little bit longer to do that. And so you've been a full-time insurance guy for how long now?
18 years. And before that, for about 3.5, 4 years before that. So, well over 20 years. The difference was Mark was older. So Franklin Life was saying, go back to your previous, your previous students and players as coaches and present it to them. I started it at age 25. So I didn't really have a lot of previous. And so that was another thing. Mark was actually had a leg up because he's, 10 years older than I am. And so he had a lot more base to continue. And he also didn't have as many responsibilities as I did. And he didn't almost have a heart attack. And by the way, I didn't have a heart attack, but I had a really bad arrhythmia because I was drinking caffeine all the time. I mean, it was really bad.
Why you're a practitioner? Why you decided to do that?
When Mark does something, he's a quick start when it comes to the Colby score. So he just jumps in and does it. And he saw that the Nelson Nash Institute was going to be something that he could learn from. And we had really good relationships with you and Carlos and Bob and Nelson. And, this was something that you guys came up with. And so we wanted to support it. And that was the original reason to do it. But then as we continued the journey, you could see that as we got more and more exposure of the Nelson Nash Institute, becoming your own banker, that things were not always being done properly. And sometimes, David, as well as there's good intentions. We're not saying everybody has a low character. They just have a low competency. And so this low competency, the practitioner program helps bring up the competency of people. And so as long as you can continue into that program, you're going to become more and more competent. And this is something that I learned a long time ago in my educational journey, is the first level of competency is you don't know what you don't know. That's a really not a good situation to be in, but it's also, you can't damage anything because you don't know, you don't know about the infinite banking concept. So you can't damage anything. The next level is you figure out you know you don't know something. Okay. So the first one is you don't know what you don't know. The second one is you don't know something. That's a little better. You can get in trouble with that because you say, well, I know I don't know it, but I'm going to continue anyway. But usually you stumble around too much and people don't listen to you. Probably the most dangerous level is now you actually have been competent enough to know it and you understand it to a certain degree, but now you think you've arrived, what Nelson says, the arrival syndrome. So now you decide, I'm not going to need any more help. I've got it all figured out. And I am not going to adjust when economics adjust, when human conditions adjust, when the insurance companies adjust, so on and so forth. What we should all be striving for is to become unconsciously competent. So this level, you're consciously competent, but you have to think through everything. You have to think, okay, when a person asks you, well, why should I not have more cash value available? And you're like, oh, I know this. The loan's going to compound faster than probably the interest and dividends are. So you're going to put yourself into a possible lapse situation. Or what a lot of people don't realize is a mech situation down the road. And we've been accused of being alarmist on this, but you can actually show people that can actually happen, especially when that term rider falls off. But the Nelson Nash Institute, I believe, and the new coaching academy, which I was pleasantly surprised how many experienced practitioners actually came to the coaching academy, because they want to become unconsciously competent. So when a person asks them, hey, why should I design it like this? They say, well, first of all, you need to think long range. The base death benefit is actually driving the dividend, which is going to buy more PUAs. The more PUAs, you're actually going to have more death benefit. The more death benefit you're going to have more dividends. And the actuaries are actually have to drive that cash value towards that death benefit, and they have to meet at age 121 in most cases. And so that's unconsciously competent. And that is where the practitioner program will help people become unconsciously competent at any time in their life. But that doesn't mean you stop learning, because economic situations change, the insurance companies change, the way you do your business changes. So you have to continually look for things. You commented on Mark, during the last Coaches Academy. Mark is great. I mean, he's been doing this full time since 1987 or 88. And he was taking copious notes at the Coaching Academy, just note after note after note. And he actually has somebody that will then transcribe his notes and remind him of the things that he learned at the Coaching Academy. I mean, this is how you build a business. You don't just go somewhere and say, oh, this is fun, and then just go keep doing the same thing you were doing over and over. So becoming unconsciously competent should be the goal of everybody.
Yeah. And the Nelson Nash Institute tries to, we don't teach 24/7. We don't do that. We provide opportunities for our practitioners to learn from each other. And it can be accountability groups. It can be mastermind learning groups. It can be shared experiences. It can be, best practices. It can be anything, but we need, we want our membership to work together, collaborate together, to learn together, to support one another. If you need help, it's there for you. And when somebody attends a think tank, for example, yeah, we want them to leave the think tank with something that will benefit them. Okay, as a professional insurance agent or just as an individual living in the United States, but more than that, we want them to contribute to somebody else. So everybody has a shared experience, and that's the essence of what we're doing, I think, and try to maintain a standard. Okay, try to maintain best practices, how to use languages properly. That's one of the biggest things that scares me is some of the language I hear out there related to infinite banking. It's like, oh, don't say that. It's either sensationalized or it's just flat out not true. So a common language is one of the promotions that we're really pushing hard for 2024 and 2025. So we understand what something means, and it's consistent throughout anybody who's in the IBC world as a professional or as a consumer too.
Yeah, absolutely. And consistent language also not only helps with the clients, but it also helps the practitioners communicate better, so that we all know what we're talking about when we say something. Um, so, yeah, I mean, it's been a nice journey. It's as you know from your experience, but that's what building a business is, and the Nash Institute is a business. It's not all linear, and it's not all compounding. It's really like this compounding. Things get better, things get worse, things get better, things get worse. But that's how you build a business, by recognizing the weaknesses and then improving, just like you did with inviting Lee to come aboard. That was a huge improvement to the Institute. So you went through a little bit of after Nelson died, you went through a little bit of a challenging situation, and you corrected it. So it's the practitioners are going to benefit from Lee's participation in the business.
Well, Bruce, thank you so much for joining us today and for all of your for sharing so many great pieces of knowledge with all of our listeners. And as we wrap up, I just want to know, what does the infinite banking concept mean to you?
Well, that's a really, really, really good question, because oftentimes I say things and I don't want to come across as like Saint Bruce, but it really is reward. I mean, I was a teacher coach, and it really is rewarding that I've been out of teaching and coaching for almost 24 years now. So almost a quarter of a century. And yet I still have some of my students and players are still like good friends of mine. And that's what happens. That's what has actually happened when you get deep into a person's finance and banking needs. We actually have a really good business, but when you sit down with a person and review, and the light bulb comes on that what they've been doing has been really good for not only them. And oh, by the way, Lee, we can't go into this, but the older you get, the death benefit becomes really, really important to the family, even though people minimize it all the time. And they frankly take out of context of this book when Nelson says your need for financing is more important than your need for death benefit. But he didn't say you didn't need death benefit. He was just saying that it's more important at that time than your death benefit need. So that's the rewarding part of it, to see people really figure that not only that their banking was taken care of, but the death benefit for the next generation. And that is really touches a person the older they get and they start facing their mortality.
Thank you so much, Bruce. We appreciate you joining us today.